Okay, welcome back, ladies and gentlemen, to capital structure and the cost of capital. Now, this is actually, you'll find this connected to our debt and equity slide deck. Put them together basically because there is an obvious connectedness between our debt and equity financing decisions and what the eventual impact is on the cost of capital. And we see that through this slide or this Excel spreadsheet that you can download from NYU, where we really can see across multiple industries what the weighted average cost of capital is for each one of those as we look at kind of the average beta and the debt equity mix that we see on average across industries or across individual firms within each industry. Okay, so I encourage you to unpack that. But so the question probably is, well, what are we talking about? What is the weighted average cost of capital? What does that even mean? Well, first, I think we need to back up for just a second to understand what the goal is of any organization, okay? Whether that's for-profit or not-for-profit. It really kind of is going to vary somewhat, but I would argue that every ongoing organization or any organization that wants to sustain itself over a period of time is going to have to maintain most of these as a priority in order to see that through. Okay. First and foremost, especially when we're talking the for-profit side, we want to maximize firm value. I would argue that we could argue that from a not-for-profit side as well. Those organizations that want to do more, want to offer more, want to provide more charitable giving, want to see more patients, want to, whatever the case may be, value really has multiple meanings. Okay. Of course, on the for-profit side, we can talk about it from a financial standpoint. From a societal standpoint, we can talk about maximizing firm value for the number of lives reached, number of lives improved, that sort of thing. Maximizing profits or profitability, that's easy on the for-profit side, of course. But I would argue that we could even argue or contend that on the not-for-profit side, that also has potential application. We want to be able to basically maximize liquidity. We want to be able to, again, earn sufficient return on any particular dollar spent to be able to sustain operations. I'll skip over WACC for just a second. We want to maximize the return on invested capital, or ROIC. This is true regardless of industry. We want to make sure that we are actually returning something, basically for every dollar invested. And of course, on the for-profit side, in this case, shareholder wealth. We want to make sure that those shareholders are properly compensated for the risk that they've incurred with regards to actually investing in our organization. But that middle one is really the focus for our attention for the next few minutes, and this is a fairly short slide deck, so it won't take quite as much time here. But we want to minimize our weighted average cost of capital, okay? Which means basically we want to pay the minimum amount possible to acquire the capital that we need in order to grow or sustain operations over both the short and long term. So that's really what we're going to be talking about over the next few minutes. And specifically, we want to be able to minimize that, that weighted average cost of capital by lowering actual or perceived risk. We want to, of course, increase cash flows, which of course provides, the banker or any sort of lending institution or creditor of any kind some security and surety that they're going to get paid back. We want to maximize operating profits. We want to grow the business, and of course, we want to reduce any tax structure to the maximum extent that is legally possible. But there are other factors that are going to influence our capital structure as well. The business risk, both in terms of the industry as well as how we are positioned within the industry. We're going to look at tax deductibility of debt and how that plays on our overall tax burden, as well as operational needs and cash flow requirements. And our ability to raise capital under adverse terms or adverse conditions. Can we still get capital even when cash flows are scarce, cyclical, that sort of thing? All those play, in various ways on what we want to do in terms of a capital structure sort of perspective. So again, Capital, I don't need to revisit in terms of what it is. Again, we're talking about the right-hand side of that balance sheet. And what we're going to do and what we're going to talk about is how do we find that optimal mix between debt and equity to ensure we're doing right by the organization. Okay? So the weighted average cost of capital, in very simple terms, is just the overall cost of financing, or a weighted average of the costs of the business's permanent financing sources. Okay? What it does for us as we start to look forward in the course is it establishes a benchmark rate of return that a business should require on any new capital investments of any kind in the same line of business as the overall entity. Okay? Regardless of how that new project actually will be financed. Okay? So even though we might be taking out a bank loan to finance something, we use our weighted average cost of capital because certainly there are structures that are already financed by other means that are going to be in other, whether it's people, supplies, equipment, they're going to help us launch this new project, right? Even though the new project might be financed individually by a loan or by a line of credit, or maybe it's part of a new bond issue, that new bond issue, that new line of financing is part of a greater structure. So that weighted average cost of capital helps us to understand what the absolute minimum rate is that we need to return from an internal rate of return perspective in order to understand whether that new project is going to be economically viable and add economic meaning to the organization. Okay? So as we look at both sides, we got to understand what the component cost of debt is as well as the component cost of equity. So on the debt side, a not-for-profit organization, cost of debt is a sum, basically the sum of all your unadjusted interest rates. Okay, because not-for-profits don't pay taxes, we don't have to do anything with our interest rates. Often, not-for-profits have access to municipal bond market, or basically the tax-free debt market. With that in mind, those interest rates tend to be lower anyway, but regardless of what that source of debt is, not-for-profits basically don't have to adjust. For investor-owned organizations on the for-profit side, we have to consider the tax benefits of that debt and adjust what our actual cost of debt is after those tax advantages are put in place. So if an organization has a 40% tax rate and there's an interest rate of 10% on that debt, the effective cost of debt would be 10% times 1 minus the tax rate, or effectively 6%. Okay? And that is what we use to build into the corporate cost of capital formula. Okay? On the equity side, when we're talking about, generally we're going to talk about investor-owned businesses on this side just for the sake of demonstration. Primary sources of equity, we understand any retained earnings that we have from ongoing operations and any new common stock sales. A primary method to estimate the cost of equity among large publicly traded for-profit businesses is, as we've seen before, the capital asset pricing model. That helps us to understand, at least from a broad brushstroke terms, what equity, or what the equity side really is quote-unquote costing us. With that, we're then able to basically develop the weighted average cost of capital. So you see here, weighted average cost of capital is just the sum of your debt side, which is those components, and your equity side, which is those components, right? So our weight on debt, as given in this problem, is 35% debt, 65% equity. So here's our weight on debt of 35%. My required rate of return on debt is 10%. Here's 1 minus my tax rate, assuming this is the same taxable entity that we just saw in a prior slide, 40% taxed. We have a weight on equity of 65%, required rate of return on equity of 14%. Okay, we put all the components together and we end up with an 11.2% overall cost of weighted average cost of capital. Okay, so what does this really look like from a practical standpoint? Well, let's take PepsiCo, borrowed from the Burke and DeMarzo textbook. We really look at essentially what the weighted average cost of capital is across 3 divisions, and we want to understand what each component piece, cost of debt, cost of equity, looks like, and what overall the weighted average cost of capital really looks like as well. And understand that PepsiCo, in this particular example, we're talking about a restaurants, food, and beverages division, each of which is operated independently under the umbrella of PepsiCo Incorporated. So here we go, estimating Pepsi's cost of debt. Here we have the pre-tax cost of debt of the restaurant, snack foods, and beverages divisions. And recognize as well the differences that we see in cost of debt and why those differences exist. So if you think about it from a purely macroeconomic, you can argue microeconomic perspective, in good economic times and bad economic times, our snack foods division will do probably better than any other division under the PepsiCo brand, right? Good times, people like their snack foods. Bad times, people will still eat their snack foods. And as a result, cash flows are more stable. And as a result, the snack foods division ends up paying a lower, albeit not greatly lower, but lower overall cost of debt. Okay. Conversely, when we see beverages is pretty tight with snack foods for much the same reason. Good times or bad times, people still like their Pepsi and will still drink gallons of it. And thus cash flows are relatively stable as well. A little bit higher though, sort of cost of debt structure for the restaurants division. If you think about from a macroeconomic standpoint, times are good, people go to restaurants more. Times aren't so good, people will tend to eat more at home and constrain some of their spending in the restaurant side of the fence. Now we have our tax rate here, implied rate of 38%. And then, of course, we get our after-tax cost of debt that varies, of course, based on our pre-tax cost of debt. Now, on the equity side, again, restaurant, snack foods, beverages division. Notice here's our risk-free rate, which, of course, is a little bit or much higher than what we're actually paying now. We're hovering around just over 2% for risk-free rate. But notice our beta, okay? And in concert with what we saw on the prior slide with regards to our cost of debt, notice how the risk factors are adjusting based on the perceived risk and volatility of the restaurants division versus snack foods versus beverages. Okay? With this in mind, the restaurants operating division has a higher beta. We have the same expected market return, 11.48% minus the risk-free rate. So our cost of equity side, of course, has the same sort of variance that we saw on the debt side based on basically the volatility or the perceived riskiness of the division in question. So when we combine these terms, our weighted average cost of capital for each one of the operating divisions, here we have our cost of equity. And notice that the mix of equity and debt also changes, right, depending on the division. Some of this might be required, we probably have a longer lead time in terms of productive base with regards to, the one division versus the other. Okay, it's an individual division, individual leadership teams running basically different businesses under the same umbrella. So their decision on how they're actually going to capitalize the right-hand side of that balance sheet is far different. Here in the restaurants division, they've decided to do a 70-30 split between equity and debt. Of course, we plug in our cost of equity, cost of debt respectively, and we end up with a weighted average cost of capital of 10.2 versus 10.29 versus 10.08. Okay, so the basic so what to that is basically we want to then be able to establish with the weighted average cost of capital, if I decide that I'm going to, and go back a slide here, if I'm going to launch any new project within the restaurants division, okay, I'm going to use as a starter rate a 10.2% discount rate for any cash flow or time value money calculations that I'm going to incur going forward. And as we look forward to the next module here in the course, we're going to start talking about capital budgeting. Well, capital budgeting is just time value money basically manifested in a broader scale. And what we're going to do if I'm incurring or going through a capital budgeting or CapEx process in the restaurants division, any project I have, I'm going to start with 10.2%. And what we're also going to talk about in that capital budgeting process is that 10.2% starter now becomes the basis from where we can risk adjust as well. because starting at 10.2%, now I can start to say, well, if it's a restaurant in another urban setting that we've done hundreds of already, that's one thing. But if I suddenly decide I'm going to build a restaurant over in Warsaw, okay, or if I'm going to put one over in China somewhere, there's going to be a lot more risk factor involved, and thus I want to be able to tax that project. I want to increase my discount rate that's built off my weighted average cost of capital, adjust it appropriately so that project is appropriately risk adjusted, and I'm not basically over promising and under delivering on that capital budgeting process. Okay, and the same would go for the snack foods, the beverages, but again, the weighted average cost of capital provides us the baseline, the starting discount rate for any future CapEx or capital budgeting processes that we're going to move through. Okay, so why would we not want to use, and well, let me go back one slide. Okay, so again, that's the discount rate for a project of the same risk. As risks adjust, or risk factors adjust, as we move into different areas that we're not quite as familiar with, we want to alter or adjust that discount rate based on our weighted average cost of capital. So why not use one weighted average cost of capital? Again, borrowing from the Burke and DeMarzo text. Here we have a global energy division. We've got three different, again, divisions. One is pipelines, one's chemicals and refining, one is exploration and development. Now, if we have a company-wide cost of capital of 11%, if I were to launch a new project, right, in exploration and development, and I assigned a discount rate for anything that they're going to do at 11%, the CEO of exploration and development would be overjoyed, right? You probably want to kiss everybody around the table, because anything that they launch at this point at an 11% discount rate is going to look overly rosy. Okay, it's going to basically overpromise the projected earnings or projected return on any project from that division. Okay, likewise, if I use that same 11% and that I'm talking about a pipelines project, okay, any project that the pipelines project group decides to launch forward, if they're overly taxed, I'm going to reject a lot of their probably viable projects because simply they're not going to bear out. Now, what should happen, instead of applying one company-wide cost of capital, I need to be able to apply those divisional cost of capitals appropriately or appropriately adjust for risk and understanding. In a global energy division, right, global energy company, I'm going to end up drilling a lot of holes that aren't going to bear fruit or aren't going to produce any oil, okay, or I'm not going to have technology that's going to I'm going to invest in, it's not going to actually produce any revenue for us. Okay, so as a result, I want to use a discount rate of 18% versus 11% to appropriately, basically I use the term tax, but appropriately discount those future cash flows so that we're not, again, over-promising and under-delivering on the returns on that particular project. Okay, likewise, over here in the pipelines, I want to use their appropriate cost of capital of 8%, because this is going to be a much more stable business, more of a cash cow for us, much less risk factor involved. In fact, when appropriately adjusted, we have a 10% spread between pipelines and E&D. We want to appropriately adjust our discount rate because it's going to be, we're going to end up, again, not accepting some pipeline projects that we should if we don't adjust appropriately. So with that in mind, that concludes both the debt and equity as well as the capital or cost of capital sections of the course. As always, if you have any questions, please let me know. Thanks for your attention.